In this video, I am going to share my analysis of First REIT's latest business update for the first 9 months of 2024. Let's see if this healthcare REIT deserves a spot in your portfolio. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and I've been covering topics about stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've covered over 500 videos and clocked more than 250,000 watch hours as of September 2024. Today, we're diving deep into First REIT's performance. Let me start by giving you some background about First REIT. This REIT holds the distinction of being Singapore's first healthcare REIT, listed back in December 2006. Their portfolio spans across Asia with properties in Singapore, Japan, and Indonesia. They own hospitals, nursing homes, and healthcare-related assets. What makes them interesting is their vision to become Asia's premier healthcare trust. Slide 1. Let me break down this First REIT snapshot for you. As Singapore's pioneer healthcare REITs, they've built up quite an impressive portfolio since their listing in 2006. With 1.14 billion Singapore dollars in assets under management, they're not just playing in the minor leagues. What catches my eye is their 100% occupancy rate across their properties. That's a strong signal of their asset quality and management capabilities. Here's what really stands out to me. They've got 32 properties with a total gross floor area of about 449,000 square meters, and their weighted average lease expiry sits at 10.8 years. That's crucial because longer lease terms mean more stable income streams. With 6,511 rooms or beds and 11 tenants, they've got a nice mix of scale and tenant diversity. Now, OUE and OUE Healthcare being their sponsors and holding 45.06% of the units tells me there's strong alignment between management and unit holder interests. Their vision to become Asia's premier healthcare trust is ambitious, but with these fundamentals and backing, they've got a solid foundation to work from. For investors looking at the healthcare sector, these metrics paint a picture of stability and potential growth. Slide 2. Let me walk you through First REIT's geographical footprint and what it means for investors. Their portfolio spreads across 3 key Asian markets, with Indonesia being their biggest market at 74.5% of their assets under management. Japan follows with 22.7%, and Singapore makes up 2.8%. This mix tells an interesting story about their growth strategy and risk profile. Looking at the property breakdown, they've got a diverse mix of healthcare assets. In Indonesia, they own 11 hospitals, 2 integrated hospitals with malls, plus a hotel and country club. Japan houses 14 nursing homes, while Singapore has 3 nursing homes. Think of this as spreading your eggs across different baskets, but with a strong focus on Indonesia. The heavy Indonesia exposure might raise some eyebrows, but here's the thing: Indonesia's growing middle class and increasing healthcare spending could be a major growth driver. Meanwhile, the Japan nursing homes tap into the aging population trend, which is like having a steady stream of demand built into your investment. The Singapore assets, though small, provide stability with their prime locations and government support for elder care services. What makes this portfolio structure smart is how it balances growth opportunities in emerging markets with stability in developed markets. Slide 3. Hey everyone, Iggy here. Let's dive into First REIT's latest numbers and what they mean for investors. Looking at their 9M 2024 results, I notice a few key points that catch my eye. The DPU has taken a small hit, dropping to 1.78 Singapore cents. Now, don't panic, this 4.3% decrease is mainly due to foreign currency movements against our strong Singapore dollar. Think of it like buying stuff overseas. When currencies fluctuate, your purchasing power changes too. What really impresses me about First REIT is their smart debt management. With 86% of their debt on fixed rates or hedged, they're like a turtle with a strong shell against interest rate storms. Their next refinancing is only due in May 2026, which gives them plenty of breathing room. However, here's the catch: about 30% of their interest rate hedges will expire by year-end, which could expose them to higher rates if not managed well. The bright spot in their portfolio is the growth in their underlying properties. Their Indonesia properties are showing healthy growth with a 4.4% increase in rental income, while Singapore nursing homes are steady with a 2% bump up. This tells me the core business is solid, like a well-oiled machine that keeps running despite external pressures. For my fellow investors, I'd say First REITs is showing resilience in a challenging environment. They're managing their risks well, and their core business fundamentals remain strong. Just keep an eye on those expiring interest rate hedges that could be the next big thing to watch. Slide 4. Looking at the 9M 2024 results, we're seeing some headwinds. The rental income took a hit, dropping 5.3% to 77 million Singapore dollars. What's really interesting is the currency impact. The Japanese yen and Indonesian rupiah's weakness against our Singapore dollar played a big role in these lower numbers. Think of it like this: even if the properties are doing fine, when you convert the foreign rental income back to Singapore dollars, you get less because of the weaker foreign currencies. The distribution per unit, DPU, tells an important story too. It's now at 1.78 cents, down from 1.86 cents last year. The latest quarter's DPU of 0.58 cents is particularly concerning, as it's 3.3% lower than the previous 2 quarters. For income investors, this trend matters because it affects your quarterly payouts. One positive note though, the total number of units increased slightly by 0.8%, which shows some growth in the REIT's capital base. As your friendly neighborhood investing Iguana, I'd suggest keeping a close eye on how management plans to handle these currency challenges and maintain stable distributions going forward. Slide 5. Let's dive into First REIT's latest financial position and break down what's happening with this healthcare trust. Looking at the numbers, First REIT's balance sheet shows some interesting movements. The total assets have slightly decreased to 1,175.9 million Singapore dollars as of September 2024, down from 1,187.3 million Singapore dollars at the end of 2023. This drop mainly comes from currency fluctuations. The Japanese yen and Indonesian rupiah have weakened against our Singapore dollar, affecting the value of their overseas properties. What caught my eye is the slight uptick in liabilities to 533.5 million Singapore dollars, mostly from new bank loans. But here's the thing: the NAV per unit has dipped to 29.16 cents from 30.18 cents. For those new to investing, NAV, net asset value, is like the real value of each unit you own. The trust also issued more units to pay their managers' fees, which increased the total units by 0.8%. As your friendly neighborhood investing Iguana, I'd suggest keeping an eye on these currency movements. They're playing a big role in First REIT's property valuations right now. Remember, in REITs, currency exposure can be both a risk and an opportunity, depending on how you look at it. Slide 6. Looking at their latest financials from September 2024, First REIT's total debt stands at 461.5 million Singapore dollars. What catches my eye is their gearing ratio of 39.3%. Think of this like a credit card utilization rate, but for REITs. In Singapore's REITs world, this is within the healthy range, well below the regulatory limit of 50%. The most interesting part is their debt maturity timeline. They've got no refinancing needs until May 2026, which is a huge plus in today's high interest rate environment. Their biggest chunk of debt, 239.7 million Singapore dollars, comes due in May 2026, followed by a 100 million Singapore dollar social bond in April 2027. The good news? About 86% of their debt is either on fixed rates or hedged. That's like having an insurance policy against rising interest rates. With an all-in cost of debt at 5%, they're managing their borrowing costs well. Their interest cover ratio of 3.9 times tells us they're generating enough income to pay their interest obligations nearly 4 times over. That's a comfortable cushion for investors to sleep well at night. Slide 7. Looking at the DPU chart, there's a clear pattern we can't ignore. First REITs maintained a steady 0.62 cents per unit throughout 2023, but we're seeing a gradual decline in 2024. The latest quarter shows 0.58 cents, down from 0.60 cents in the previous quarters. While this might seem like a small dip, it represents about a 6.5% decrease from last year's numbers. For those planning to catch the upcoming distribution, mark your calendars. The stock goes ex-dividend on November 12th at 9 a.m., and you'll need to hold the shares before the book closure date on November 13th at 5 p.m. The actual payday comes on December 20th, 2024. Here's a pro tip from your friendly investing Iguana. If you're thinking about getting in for the dividends, remember that REITs typically price in these distributions, so don't just chase the yield without looking at the bigger picture. The declining DPU trend suggests we should keep a close eye on the REIT's underlying performance and what's driving these changes. Slide 8. First REITs is making some bold moves with their 2.0 growth strategy. What catches my eye is their ambitious target to boost their presence in developed markets to over 50% of their assets under management, AUM, by FY 2027. Think of it like diversifying your investment portfolio. Instead of putting all your eggs in one basket, they're spreading their risks across more stable economies. Right now, they're at 25.5% as of December 2023, so there's still quite a journey ahead. What I really like about their strategy is how they're cleaning up their portfolio. They've already sold off Salon Hospital Surabaya and are looking to sell Imperial Area Duta Hotel and AMP Country Club. It's like spring cleaning your investment wardrobe, out with the old, in with the new. Plus, they've got their finances sorted until May 2026 with no refinancing needs, and they even launched Singapore's first healthcare social bond in 2022. The cherry on top? They're investing in energy-efficient upgrades worth 1.12 million Singapore dollars, showing they're serious about ESG. For investors looking at healthcare REITs, these moves suggest First REITs is transforming from a regional player into a more globally diversified, sustainable healthcare trust. Just my 2 cents as your friendly neighborhood investing iguana. That's all I have for First REITs' latest updates. If you found this analysis helpful, you'll definitely want to check out my deep dive video on First REITs, by now, says Phillip Capital, where I break down Phillip Capital's bullish stance on this REITs. I explore their target price, growth catalysts, and why they think it's a good time to add this healthcare REITs to your portfolio. The video pops up right here on your screen. Just click to learn more about the investment case for First REITs. Until next time, this is Iggy, your friendly neighborhood investing iguana, signing off.